Welcome back to Trader Sage, where we're going to review price action utilizing ICT concepts, time and price theory, premium discount, PD arrays such as fair value gaps, inverted fair value gaps. Those are the key staples of my setups. You got order blocks and you have breakers, of course, all the other stuff, propulsion blocks, treat wicks like gaps, breaking that into quadrants, treat the gaps and break those into quadrants if necessary, stuff like that. But anyway, I'm low key just want to clear the screen, but this is the 4-hour chart. It's where I usually start at. If it's not clear, then you move down to the 1 hour. But this time frame is where I like to look for market direction, right? Internal range, external range, liquidity, those types of things. Look for divergences on this time frame as well. So yeah. All right. So right where my cursor is, 1400 hours on Monday, July 7th, is a divergence on the YM because it ran that low here, but then the NQ and the ES refused to do so. So let's just clear the screen. It's just only like one drawing on there anyway, but let's highlight this divergence here. Let me say run on stops. Let's do something like this here too, right? To denote that, turn that black. Any color you want. It was a divergence. Let's turn this off for a moment. We had a higher low here. So this is a lower low. Run stops here. Sell side liquidity. Ran the liquidity here. This is significant low high, only because this imbalance, this inefficiencies here, and this is broken here, right? So those of you who have been here for a while and know my A+ setup is a run on stops followed by break in market structure, key levels, intermediate term high here because of the inefficiency here. Once that's broken, a retracement into a PD array or an imbalance below 50% of the range. So this is broken here. You could have gotten on this low, right? Because it's open here, high, open, high, low, close. And that would be an entry here, right? Boom. And this is still a 4-hour chart, so it doesn't, like, you know what I mean? Like, what day is this? This is Wednesday, 10 o'clock. It's 2. All right, so we have this. Let's do this here. So we have this entry here, and that's also an optimal trade entry as well. And just by looking at it. And I'm eyeballing it as usual. So you want to be more precise than follow along or whatever, right? So optimal trade entry here, and I have this. Oh, I didn't put it for the 4-hour, but let's do this. I think that's valid, 4 hours. And let's increase the size for those of us in the back. 10. All right, so optimum trade entry long right here, entry at Wednesday, 10 o'clock candle. And then we have a retracement during the London session, which is now you do breakers, right? Because you got a low, high, lower low. So all of this would be a breaker. You can use that, or you can break this into quarters. Right. So let's put this magnet back on. And just do orders. Right. Let's walk this out a little. Almost hit that 50%, but whatever. So from here to here, it's also, this is swing high. You can't see that. Then we can use fractals indicator. So you see that swing high, you got to swing low, swing high, right? And that would be also, so we holding this level here. It's getting noisy. I want to delete stuff and turn stuff off, but whatever. So here to here. So this high to this low, that would be an optimal trade entry 2. Let's see what that looks like. Right, 70.5. 70.5 optimal trade entry long. 1 standard deviation was the target for today. Utilizing this range, this low to this high, and optimal trade entry. So that's fine. 1 standard deviation. And let's see what the previous swing low. We're using this low and using this high. And that would have gave it 61.8 and stopped at the -50. All right, so let's see if we fine tune it utilizing the lowest low, the lowest low of this 3-bar pattern, using the bodies only. Let's see what that translates into. So it's not quite optimal. There you go, your optimal trade entry, and now we have 1 standard deviation just utilizing the bodies. So someone asked me, hey, what's the rules for this? I think for me right now, I would leave this small wick here and chop the long one. Why? Because the long one ran stops, like significantly ran stops. So probably would do something like that in this regard here. With this entry, 70.6. So it kind of tightens it just a little, and you still get your 1 standard deviation. But that's for me. That's not necessarily for you. So don't. It's one of those, right? Don't do this at home type things. But anyway, that's the YM. So we going right back to talking about the divergence between the YM and this swing low. The NQ refusing to run the swing low, and we have the ES also refusing to run the swing low. So we have a divergence, right? All right, and honestly, you can have like your, so that's like right here, right? So it's the entry is somewhere over here. This is where this one right here is where the low ran the, you see it right here. So this candle here didn't run the low. So we're looking for an entry somewhere around here, right? This one is an immediate rebalancing of the price range. So that's an upside move. Doesn't move with as much force and strength as this one, right? And you can see here it ran the high, previous week's high on the NQ. It failed to do so on the NQ, right? So this is what I mean by this is the leader, and now it's being the laggard. It's holding everybody else back because it's the ES ran the previous week's high as well. So this will be Tuesday, 1800 hours. There's a swing low, and this is the range for this. This would be the range for this would be the range here, or this range from here to here. Anyway, 1 hour chart. Here's your divergence again. Here, highlight it. And here, highlight it around the low. That would be your 4 hour fair value gap that's highlighted here. So you got to, right? So this time frame, 1 hour, run on stops. You have a small bearish fair value gap here, the 1900-hour candle on Tuesday, July 8th. So bomb, hit it here, retrace a little, right? Looks like about a quarter, about a halfway mark on the wick of this 2100-hour candle. But in any light, you don't have to necessarily take this run up unless you saw it clearly, right? Holding above the midpoint of this down close candle. If you didn't see it, then you don't see it, right? You can call it whatever you want to call it. Failure, like reclaim the swing low, whatever. Reclaim the level, however you want to see it, right? And what I mean by it held above the midpoint of the swing low of the down close candle. This one. Maybe you don't like that one, then you can do something else, but whatever. Anyway, I wouldn't have traded on this time frame necessarily, but I'm just using this as a talking point. Let's look for setups, right? And the one that had the run on stops, it seems like the setups are clearer, right? Setups are much clearer. So here we have an inverted fair value gap, which I'm speaking of. Now it broke above that. This candle would be your, so this would be your turtle soup, obviously. This can be your low risk buy. But if you don't feel confident about that, then breaking above this bearish fair value gap, turn it into an inverted fair value gap. And by definition, an inverted fair value gap signifies change in the state delivery. Meaning we were once bearish and we may now be bullish. Why I say may is because this is a probability game. We don't. All right, so that's the inverted fair value gap here. And this would be your entry, right? This is immediate rebalance. It's also a PD array, immediate rebalance over price range, kind of indicating the potential for price to want to seek high prices as well. And you can use these relative equal highs, this swing high, relative equal highs here as a target into this bearish fair value gap, which is above 50% of the range here. That would be your 50% PD array. So this is your premium discount, your premium array trading back into discount. I'm just going to drag that out. So, right. So that would be your premium array. Bearish fair value gap, sending price down lower, say into an order block. We can say back down into this inverted fair value gap. And you see here, price is trading between, now it's trading between this range and this range. Pull back, now price is trading between this range and this range over here. So that's also optimal trade entry long here. That would be during the London session, right? And London kill zone. This entry here would be pretty much at the end of your, so your silver bullet would be this, your 10 o'clock silver bullet after a run on stops. Oh, I'm like yapping, right? Anyway, that would be a, where we at with it here. So that's your 10 o'clock trading into this imbalance. And this is 11:15. So this, all of this here, 10 o'clock, it's right here. There's your divergence over here, right? Run on stops. Run on stops. Well, what time frame it ran stops? I'm not gonna talk about that though. It's order pairing, followed by breaking structure here, retrace into here. Got caught up, ran the low. So optimal trade entry wise, this is still a valid setup because your stop loss would have been here. Right, but then also you need to consider time and price. So all of this is bogus, bogus, bogus. And then you get into the 2 to 5. So time and price, this would be your swing low, swing high still. Optimal trade entry during the London kill zone. And it's just been glorious until pretty much the equities market opening 9:30. This is the market discovery time frame. And he does have this rundown. I'm not even sure what this black thing is. I think, I don't know when I drew that. Swing high, previous day's high. Previous day's high. And, you know, so anyway. So optimal trade entry, boom. Where were we? So London session, optimal trade entry here to here. Right, this low to this high, optimal trade entry long. 2 standard deviations is here. 3, 4 standard deviations, glorious. And to consequent encroachment of this at a 1 hour bearish fair value gap, and bomb right back down into that 1 hour inverted fair value gap that we spoke of. So price action on the YM obviously very clear. And then we want to look at, so here we go with the run on stops is here. Let's see. So this on the higher time frame, this was the run on stops. This missed out. So this is why, like, so this was the lead. This was the leader. Ran stops, price action very clear, return to origin essentially, and then it took off. Right. This one, it didn't run stops over here, but it ran stops over here because this had to catch up to this running stop. So this caught up to that running stops. Another divergence, obviously, with the NQ divergence here. So the one that ran the stops should have a cleaner entry model, in my opinion. Maybe in your opinion, the laggard may be the one that has a clearer entry. So this ran stops here, 5 minute, didn't run the stops here. This was a glorious entry. Here it would have been a failure. You would have got stopped out trying to follow this one here. Right? So here price ran the low, and this happened during the London kill zone. London kill zone, run on stops. It's only on the NQ. And now you have the run on stops. Engineer liquidity here. There's your swing high. Pull back into this inverted fair value gap here. This was a good entry. Right? Pull back down into this bullish fair value gap and also the midnight opening price. Breaking structure again, pull back into an imbalance because all of this is here is imbalance. And then rally higher. So this one here had to wait, didn't run stops, kind of ran all this noise here, but anyway, didn't run stops. You're still looking for breaking structure, ran these relative equal highs, pull back into this bullish fair value gap, and then continue higher. So let's see. So low key, you still need to, whatever asset you're trading, you still need to wait. Like, still need to wait for your setup to form. And why this swing low versus this swing low? This had the more dynamic price action move. Like, yeah, this is bullish, but this is like, this created imbalances. This is where it's at. Pull back into 70.5. Low here, 62, 66, 25. Optimal trend entry was 65. Oh, that's the green bar. 62, 66, 25. So just kind of stab down into it. Ballot, the low, same as the entry. And I eyeball it, so maybe this is off. Nope, it's not. So anyway, doesn't matter. Still optimal trade entry long, 1 standard deviation, 2, 3, possibly 5. So let's see. You guys already know I'm like wild curious all the time. So let's check it out. Didn't reach 5. Let's play around, see 4.5. Definitely overshot 4.5 though, but yeah. All right, so that was a nice run if you caught it during the London session. And how does that look? All right, so that's that pullback here. This pullback here into the inverted fair value gap is the same pullback here. Running stops and then pushing higher. Kind of fell before it reached the top, but or reached the swing high. But look what's hiding in the bushes, right? This inverted fair value gap hiding out. Like, you're not going nowhere, buddy, right? Hit it here, shows that it's significant. Try to bust through, failed. Just keep hitting these levels. Consequent encroachment just dropped. Like, but I like that. I like that. Anyway, I don't know. That's all I got for now. I got other stuff to do. But let's see what happened. Let's see what's up. Let's see what's up. Just because we here. 5-minute. This ran the low. This ran the low. All ran the low. This ran the high. This ran the high. This failed to run the high. Oh, nope. This ran the high. This failed to run. Let's swing low is here. So it didn't run the swing low. So this one here, possibly ready to run. Probably got to wait for these ones to match up, catch up for the continuation trade. Let's see. All right. Let's see the optimal trade entry long here. And I'm just freestyling because, all right. So it's around a key level as well. So optimal trade entry long here. I already tried here. Bullish, bearish fair value gap here. And a bearish breaker here. Sent that back down. Bomb brand stops. But it's still holding above this balanced price range here. Or you can use the weekly opening price. So we really want to see price run. You can just use this as a substitute. Really want to see price run this low and stay below this low, which is corresponds to this inverted fair value gap. Then we could agree. So let's see what happens once these match up. In QES, everybody kind of like go into agreement and see what happens. So just waiting. I guess we're waiting for the YM to run the low. Let's see what happens. Is it? Is it? It shouldn't though, right? Balanced price range, it should go higher from there. But let's see what happens. Does it have to regroup with everybody else before it runs higher? or will it continue lower? This is why one of the dangers of this looking at this lower time frame chart alone is that you're not trading the patterns for pattern's sake. You can easily say, oh, this is a market maker buy model, this is a sell model, and then price should go back down here somewhere, or at least get caught up over here, discount premium, right? That's the ideal. That's the thought. That's right. Trading in probabilities and trading in terms of like likelihood, stuff like that, that's essential too. But also utilizing the high time frame to gain better perspective on what's going on. Like, what is this doing? Right? Because this did break market structure here. There's your broke market structure here, retrace into this inverted fair value gap with this bearish fair value gap. Onto technically it's traded back down into discount. Then this range here traded back up into about 50%, and then now, so yeah, it's just a bunch of ranges within ranges within ranges, right? So this right here to here, again, I'm just doing this to show 50%. I'm tweaking this right here to show 50%, right? Traded above 50% and then dropped. So far so good. It didn't run the low. Or the time frame, this is a higher time frame. That's like it looks different, right? Low, this is still you can still see that is a swing low. That's a higher time frame swing low, right? Because like over here, this is where this is the third candle on like the 1 hour, possibly like the swing low here. That's what I see. Like, this is the swing low, higher high, higher low. That's what makes the swing low. Obviously here is this one in this time frame, but if you think about a bigger scene, then it would be these two. And price is just bleeding slowly. There's it. YM about to join in with everyone. Anyway, I'm about to check out. Checking out at what? 2 more minutes. Well, minute and a half. So still ain't running low. Like, come on already, right? There's also no setup for a long here yet, unless you're doing like a turtle soup entry. But right, still like you want to see, right? You want to see, you can just, is it good? Is it good? Is it bad? Is it bad? Is it good? It's good. It's bad. See, still bearish. Still no. And he's finally took out the swing low. Now let's see. Did it take it out? Didn't. There we go. Oh, gusto. We get some volatility there. Momentum, right? Right, so boom, it like busts down below here. Now everybody's all gang. Everybody moving together now. All in together now. Fun, right? Like, and it's reading price action, just reading the charts, reading the tape, as some would call this, reading the tape. This is still a representation of buying and selling, you want to say, or order flow here in the charts, right? Same way how you don't have to necessarily have volume on your chart, because the bars are going to tell you how much volume was in each candle, each bar. Throw volume on there, see what we're talking about. I'm not going to talk about it. You guys just I'm gonna observe. See, like, right? Small volume than that one. Smaller volume. Sometimes this volume charts don't speak. There's divergences there too. Everybody, you see it. You see how it ran the low, and then there's like so much more. Like, you're gonna say, let's just say selling pressure. So much more selling pressure there. Now we have another divergence, right? We're not just sitting here looking for divergences. You're gonna look for buying and selling opportunities. All that's here. All that's here. All this is here, right? Bleeding. Isn't that glorious? So now you're gonna say, okay, great. Like, now we actually below 50% of this range here. This is like where you get into like, oh, where can price possibly get snagged up at? And will it violate that level? So that would be here, your bullish fair value gap here. It's also in a discount. Right? I mean, if price break through that, then it becomes an inverted fair value gap. If it does it with force, you have more conviction. If it's going to hold that level, then you may want to like consider exiting, right? This is good money, right? It's good. Does it excite you? Makes you just want to jump in, right? But whatever. Mark is going to always, so look, you're going to see here, and then you can keep watching this chart. That's this here. Right? Valid. Same thing here. This is where you go, like, oh, it's violating media rates, right? Also, obviously here, below 50%. Clearly see this optimal trading tree, long opportunity, but you need confirmation if you're going to take it. Like, where's the key level? Key level is still around the previous day's high at the very minimum. Previous day's high is here. So yo, I said I was leaving in like hour and 30 minutes, but it's almost now I'm gonna leave in an hour and 30. I don't have a timer on. I'm just watching this price action here. It's good though, right? And it bled out 1955, 755. Part of this range. This dominant price range, bam, bam. Also part of this range, bam, bam. And then bullish fair value gap. So this got to run on stop. It's got to break in structure, break in structure, break in structure, break in structure, and the retracement into the price leg that caused the market structure shift. This is how, where is price coming from? Where is it going? This is a 5-minute chart. Right? Right? That's good. Right? Then boom, right? On top of that, that's messed up though. It didn't snatch it where it's supposed to snatch. Right? Optimal trade entry, short. And we approaching 1 standard deviation. All of that's not necessary, not mandatory. So scaling out, target 1, target 2, and we almost at 1 standard deviation. And you see what the volatility came into the market at, like literally once the YM kind of caught up to the divergence here. These are 5-minute bars, so see here, this violated that, so that was an inverted fair value gap. You just see, now you want to see what happens here. Well, you can say, hey, this is a breaker. It's up to you, right? But price can violate all of that. And we about to get off 1 standard deviation here. this one here, and but didn't run the stops. This already ran it. This already ran it too. I wouldn't be looking here. I'd be looking more so here because this showed that price. This was significant enough to hold price up. So we'll see what happens here. Still going, right? This target, boom, done. Like, get out, bro. Didn't happen during the age of kill zone. All of this. I don't even know, like, normally I don't keep, just turn everybody on. Turn all of you on just to be curious. Was there any news over there? Nothing? Nothing. Nothing economic news. But I heard Linda Rasky say that, hey, like, you don't worry about the fundamentals. She trade straight technical patterns. So straight up technical pattern. So all right, so boom, right? Just trying to make this swing low. You just keep bleeding, right? Look at this. This broke right through there. That was nice. What did you learn today? That was nice to me, right? And then the 1 minute play this part if you want to use below 5 minutes, because then you possibly see potential reversals before they start. Or you can just be patient and wait for them to happen on your desired time frame, like this 5-minute chart. Anyway, I'm done with what I had to say, and I'm still over my man. These charts be like, it's like a calling, man. Let's get it though. Please like, comment, subscribe, and let's be patient. Let's continue to just be patient, man. A lot of us know what we're doing in the market, and we are sabotaging ourselves in some way, shape, form, or fashion. You can call it FOMO. You can call it trading on tilt. You can trade it. I call it 11:59. 11:59 minute right before midnight. Right before it's almost over, you throw it all away. You throw it all away. Like you were a champion, right? You were the champion. Like if you tortoise in the hair type deal, right? Like look at that. Beautiful. Almost completed. Consider this to be the consolidation, the original consolidation here. And it's done. 2 standard deviations will take this out. That was around the key level. It ran the previous day's high. Let's see what else we had back here. Previous day's high. Monday's high. Got snagged up. Looked like it got snagged up, and for this one, ran the previous week's high as well. So you can say, oh, it ran the previous week's high, then retested it. Then that's your retracement here. Right, done. You can have that as a narrative too, right? Depending on your trading style. So right now, using the midnight open, we almost at like a doji right now. Where are you, man? No, it's way over here. What we want to do? Too close. Back up off me. Still, you're too close, bro. Oh, they playing these. All right, that's better. All right, so obviously one day New York Open can do power of 3 and using the midnight as an opening price. This is what it would look like. Using the 1800 hours as the low. This is nice. This is nice. This right here, man. Blood in the water, man. Blood in the water. No, don't be amazed, right? This is so you did power of 3 using the 1800 hour opening price. Is this do this? weekly and open hours. Right. So 800 hour opening price, the gap up, then we open a day, you want to call it. So it opened here, then ran up, right? So opens here, ran up into that imbalance, and then this, give me that. Give me that. Not even mad at it. Like, so now you see this took out all of that. 2 standard deviations, that's good enough, blood. Done. Like ICT mentioned on the, this is the model, optimal trade entry model, all of that. This is it. Get out. Stop being greedy, right? You know. Anyway, I'm done here. Thank you for tuning in. Thank you for listening to me run my mouth. We all got this passion for trading, so don't forget to pay the trader, man. You work hard for this, man. Don't forget to pay the trader. All right, deuces.